Thank you for everyone for joining in. My name is Muhammad Uwaisata Siddiqui. I'm the founder of Mastering FRM, and we are so honored to have Imranullah Khan with us. Just a brief introduction. He has a vast experience of working in a lot of organizations and working towards getting strategization, mainly in the area of risk management, specifically financial risk management. He has worked with big fours in Middle East, in fast and and has undertaken several regulatory program assignments. Academically, he is a chartered accountant. Thank you, Imran, and welcome session, and thank you for your taking your time out. Couldn't cover everything. So if you could just briefly share your journey. We know what you have been doing. So where did it start from? Why risk management, and how has it been going?
Thank you, Wes. Thanks for the introduction. Thank you very much. I started my career as a chartered accountant, and I spent almost half of my career until now as an auditor of financial statements, as an external auditor. Most of my experience has revolved around financial services and banks, to be really specific. However, you would appreciate this fact that after the great financial crisis of 2006 and 2008, between 2006 and 8, a lot of regulations have been enforced to keep the performance of the financial services in line. And I was also caught up in that wave as well, and gradually and slowly moved into risk management, which was a hot topic back then, and I believe it is now as well. And in the foreseeable future will remain the same. And in order to cope up with those specific academic dynamics of risk management, I had to undertake financial risk management from GARP as well. I played that in 2016 just to increase my capabilities. Anyway, so this is basically my journey, and in doing so, I've worked for and worked with a number of institutions, financial institutions in Pakistan, mainly as Pakistan is my origin, but also I have worked in Middle East, Saudi Arabia, as well as UAE, as those countries that I have worked with, and also I have spent considerable amount of time in Far Eastern countries, Malaysia, to be specific. But we had to cover from Big Four's platform, the ASEAN region that includes Hong Kong, Singapore, and to a certain extent Australia and New Zealand as well. So I had like a lot of geographical experience implementing challenging standards, regulations, revolving mainly around financial services. But however, the same principles could be applied in other institutions and organizations as well, because the principle remain the same. So yeah, go ahead, Wes. Wes, I believe you're in mute here. I'm unable to properly hear you.
Okay, I'm saying that you have the host, right? If you could just go
Okay,
to
sure, sure.
Phoenix Hot 6 and click a mute on it,
All
because
right.
I'm not able to do that.
Okay, great. No problem.
Yes, perfect. Okay, great. Thank you. And it seems that you do have a lot of experience. So I think you should just start with your presentation. You can share your screen straight away, and let's discuss the IFRS 9 implementation challenges.
No.
And before we do that, just please tell it how long have you been working on IFRS 9, and what has been the journey in IFRS 9 implementation specifically?
Yeah, in fact, I'm one of those, I must say, lucky enough. And fortunately, many professionals are out there. When I was working in ASEAN region, they implemented IS39 for the first time. So that was my first flavor of financial instruments implementation. And you understand that IFRS 9 is also an extension of IS39. However, in Pakistan and in wider GCC, I've been involved in it since late 2017, late 2018, 19, and still the progress is happening. So around let's say four years of good experience of learning IS39, implementing it, the challenges of it, and now IFRS9, which is a completely different animal compared to IS39. But yes.
So you had been working basically when it actually started, even before than that, because IS39 is actually the foundation of that. Amazing.
Yes,
So I think you should
exactly.
move ahead with
All
your
right.
presentation.
Yeah.
To the participants, we will take some questions in the end. So if you have any questions, you can keep asking. And if there will be any question that I will feel that should be asked straight away, I will interrupt Imran in between and ask it there and then. Okay, Imran,
Okay.
over to you.
Thank you, Wes. Okay, so just what the presentation states over here, and the next 1 hour will try to ascertain, assess, and try to find mitigations around the challenges that are usually encountered when implementing a rigorous, robust, and comprehensive standards such as IFRS 9. The areas that would be covered are actually a lot, and that's what I was having a discussion with the ways at the back end, that there's a lot of ground to be covered here, and I'll try to keep only those areas which are really critical, and accordingly will move with that respect. Uh, just having a go at the agenda over here is that it is very important to understand why IFRS 9 exists and why is it being implemented. Why aren't other standards like IS39 and other practices around risk management, aren't they enough to fulfill that role? And what IFRS 9 is trying to fill the gap. This is extremely important because and standards such as like IFRS 9 has a lot of cross-functional integration within the organization, and unless and until you obtain their buy-in, the complete implementation becomes a very challenge. Another area would be that IFRS 9 implementation or any other standards implementation from that perspective should not be considered as a matter of only meeting the deadline. That's not the end of the story. That's basically the beginning, and we'll try to touch what are the other areas that would be touched upon. Another important aspect is who are the key players in the implementation, what are the expectations, so that those who are implementing IFRS 9 always keep a check on the expectations of the key stakeholders, and extremely important, especially a humongous task at IFRS 9. You don't want to end up at the last moment realizing that some of the key expectations have not been accounted for. Another area would be the implementation effort matrix or areas, where we will try to see that within the implementation of IFRS 9, what are what are those key areas where most of the efforts are required. Then we will dive into the IFRS 9 implementation challenges. That is, I've divided that implementation life cycle into classification and measurement. ECL, obviously, that is one of the key challenges in implementation of that. How to account for the macroeconomic overlay, what are the challenges behind it, and what kind of governance controls could be used. As well as we'll also see whenever complete data sets are not available, how do you ascertain what proxies to use and what could be planned to eventually let go of those proxies and eventually drive the actual results. Finally, we'll recap because we will have covered a lot of ground by then, and it would be a quick guide to see where we stand with that. So I'll go straight into the genesis of IFRS 9. Now, this is extremely important. The principal components of IFRS 9, or what the principles that it alludes to, have a very strong backing in applied sciences, in risk management, even before IFRS 9 came into being. That's the principles of credit risk management, been around, using the multiplicative principles, LGD, VAR, and factor-based macroeconomic analysis, Monte Carlo scenario assessments, and These have been, have been around for a while in other risk management areas. And what then why is IFRS 9 trying to adopt that in a financial reporting perspective is that while the financial crisis of '06 and '08 gave rise to a chain reaction of regulations and a deep learning or deep lesson learned from the same, was that there was a lack of, there was weakness of governance around risk management practices as well as the business management practices. The principles used for credit risk measurement and management has been around for a while in risk management areas. But however, they were considered a little silo, and select few individuals that the senior leadership of big banks used to use information and make judgments according to that. However, what IFRS 9 does is that it brings those assessments, those measurements and management implications into the fore. It makes it part of the financial reporting. That means all the information is readily available to the users, which can have a critique on it, which can have intelligent discussion and debate around it. And accordingly, it would prove to be a good check and balance on the management, senior leadership as well as the investors would be able to make a more informed decisions. So that is basically what IFRS 9 is trying to achieve over here. Now, I'll move to the next area where it is where I'm trying to communicate over here is that IFRS 9 implementation should not be considered a basic meeting of regulatory deadline. It's not like that. Perhaps for other standards that would have been the case, but IFRS 9 is very comprehensive. It touches a number of areas. Therefore, meeting regulatory deadline perhaps should not be the key focus here. And other aspects should also be brought into planning, because every one step is an input to the next phase, and this is how you achieve a full life cycle implementation. So on the top of the iceberg, it appears like, yeah, regulatory compliance is a key factor. But however, if you look at, have a deep dive, you'll see that the quality of implementation affects a lot and have some really interesting consequences for any organization moving forward. You might be able to cross the day one implementation very easily, but later on, it would be a challenge to untangle what you have created in a rush. The third is you need to develop tools and capabilities in-house, and so reliance of consultants might not be the ideal approach. However, for meeting the regulatory deadline, initially consultants' input is extremely important. In fact, it brings in certain degree of objectivity and transparency, because you will be working with cross-functional teams, and having an outsider expert tries to align the expectation across the board. But however, moving forward, tools and capabilities, select hiring, investing in the people is also extremely important. Number fourth is that the evolving best practices. And IFRS 9, although in some jurisdictions have been implemented 2 years ago, in Pakistan, to be really specific, we are due to implement it from 1st of July 2021. And currently, most of the financial institutions are in the phase of having a parallel run. So it is extremely important to see this whole project from have a bigger view around the implementation of IFRS 9. Moving on next, IFRS 9 touches a number of areas, and it isn't like other standards where implementation of such standards or the working groups could have been siloed within the finance function, and if the data was required, IT could have been requested to provide that information. However, IFRS 9 is way too comprehensive, and it's not just measure of convenience for reporting. However, it will drive your decision making as well. But however, in order to understand what kind of landscape we see for the stakeholder engagement purposes, we can classify these stakeholders into two categories. One is the preparers, the processors that are directly involved or in some way indirectly involved in the rollout of of IFRS 9. And these are typically finance, risk management, and technology, because IFRS 9 is quite data intensive implementation. However, the other category are the challenges, which basically challenge the assumptions, the results achieved, and the recommendations that would be made by the finance or risk divisions. Chief among those challenges are the regulators themselves, the board of directors, the external as well as internal auditors, because one represents the fourth line of defense, the other is the third line of defense, and the last one is the senior leadership, because they require the output from the IFRS 9 to drive the decision making, the risk appetite setting, which is eventually ratified by the board. Now, it is extremely important to engage with your stakeholders upfront, and just to give, and many jurisdictions have already come up with a lot of guidance from regulatory perspective, how to run stakeholder management. And just to give a simple example from Pakistani perspective, State Bank of Pakistan, which is the central bank, the financial service regulatory authorities, have issued a number of guidance setting the expectations for the challenger group, that is board, external auditors, senior leadership. In fact, they have gone as far as detailing the minimum terms of reference of the number of committees that needs to be established and to be run against. However, when we try to engage the stakeholders, a couple of challenges that could be overcome are mentioned in the regs, and that is a theme I would be following in the rest of my presentation. Wherever a challenge or a mitigation is mentioned, it would be highlighted in red. So therefore, it is to be understood that IFRS 9 is a complicated subject, and for challenges to be well equipped in order to challenge the preparer, we need to make awareness sessions within the senior leadership as well as board members, because they will be eventually be the group that would be challenging the assumptions around that. We need to present reporting performance as well as so as to guide these challenges, what kind of decision making is achieved from the reporting tools. Extensive training sessions could be required, and then extensiveness depends on what kind of challenger body you are dealing with. However, I think the most significant training sessions or the extensive training session would be applied for the senior leadership, because they are, after all, at the end of the day, responsible for day-to-day operations and risk appetite deduction, which is ratified by the board as well. The last the aspect is being pretty proactive when it comes to stakeholder engagement, and especially this is with respect to your auditors, and especially external auditors. This is one of the lessons I learned from one of my learned colleagues, is that the audit, especially external audit, doesn't only start after the year is ended, and you don't need to wait for critical issues to be brought up by auditors at the last moment. It's in fact a matter of best practice and a choice of good governance to keep your auditors engaged throughout the year, so that when the reporting year end comes and the external auditors are required to present prepare their report, they have ample time to cover their areas. This is extremely important, especially if your financial institution is a listed entity, which might be very much so. Any delay in regulatory filing could erroneously that something's wrong, which might not be the issue. So it is extremely important that stakeholder management is accordingly addressed. Moving on next, this is a very simple description of the areas which require most effort in the implementation of IFRS 9. Now, these impact areas are classified into four, and the usual culprit is obviously ECL modeling, which is the basic challenge in IFRS 9, but certainly not the sole challenge over here. And the effort level over here is the highest. It's not only the setting up of ECL, implementation, modeling, creation, validation, but also as an ongoing activity, capability enhancement, reporting, and monitoring. So ECL in our experience has always been on the top of the list. The second is the classification and measurement, which also, in IFRS 9, they have come up with two sorts of tests, which I will explain in later slides in more detail. That is business model test as well as contract level SPPI testing, which is fairly detailed and might be very prescriptive. But however, we don't see so much of a challenge, especially from Pakistani as well as GCC market, because most of the products that is being sold by financial institutions appear to be very debt-like, and much to do with the maturity of their capital markets. Not many products are indexed to other criteria. So therefore, a pre and post assessment of IFRS 9 classification you would eventually end up having the same percentage of banking book that you started up with, and that usually is more than 75 to as far as 85-90% of your SSI that is still end up being a banking book that would attract the amortized cost method and measurement. The third thing is the hedge accounting, and there's fairly less exposure for Pakistani banks, mainly due to the less liquidity in the market and availability of exotic products. So therefore, they are also IFRS 9's implication with regards to hedge accounting is not that significant. And the last is the program management, which is basically taking all the areas and in a very project management principled way and running it smoothly so that all the expectations are catered for, the standards are properly applied, regulatory expectations are fulfilled. But for that, you need a cross-functional program management. You need a strong project management office. Its scope is fairly wide, and buy-in from cross-functional teams is extremely important, as well as stakeholder management. So this is also a very an activity of in itself, and it cannot be disregarded at all, because you have to understand the IFRS 9's the spirit is to remove these varied risk management practices from siloed to an integrated framework. And believe the program management, those successful banks who have implemented have approached this thing from a robust program management approach. Moving on next. Now I will start with the actual implications of IFRS 9 from reporting, modeling, and data perspective. What are the challenges, and do we have any mitigating solutions, and what's regulators or external auditors expectations around that? So as just the standards lays out its contents, so we'll take the same approach and we'll start with classification and measurement. Now, in IFRS 9, the IFRS 9 has suggested two approaches. That is business model test approach, as well as sole payment for principal and interest test. That is SPPI testing, called in short form. And the approaches are deduced in a residual manner. That is, whatever doesn't pass these tests are to be classified by default as fair value through profit and loss account. However, if they do not, they do pass it, then they have to be accordingly classified either as under amortized cost method or fair value through OCI method. Now, as I earlier explained that in our experience that we have seen in Pakistan, especially as well as GCC, the high expectation is that 85 to 90% of your banking book would remain within the banking book. That is, you can still carry on with the amortized cost method that you had been applying before IFRS 9 came into the picture. However, there are certain challenges, and this is from the perspective of, especially from Pakistani context, and that the departure, IFRS 9 now requires that unquoted equity instruments, those equity instruments that behave like equity, that is, their returns are tagged to the business and discretion on the counterparty's board to issue any dividends, and if they are not listed, that means you do not have readily available direct quoted price. You would need to apply valuation methodology in order to account for such equity instruments as fair value through profit and loss account. Now, I'll just give a little flavor of how the Pakistani banks used to account for such prior to IFRS 9 was these unquoted equity instruments used to have a backstop valuation approach. That is, you had to book it at the lower of your cost of investment or the breakup value of the investee company. That is net asset value. So whatever is lower, you had to book accordingly, and if the price and the value goes lower, you have to accordingly account for it as in depreciation in the value. But however, IFRS 9 now requires to apply the principles laid down in IFRS 13, which is basically a leveled approach of level 1, 2, and 3. And in very unusual circumstances, and if you can justify to your external auditors that even such application is not possible or it's not maybe material enough, you can keep it at a cost level. But that is a matter of debate, and these are one of those things that you would like to engage with your auditor earlier on, especially if you have a good understanding that you will not be disposing of these equity instruments at the reporting date. Another peculiarity with when you interact IFRS 9 with the instruments is the Islamic financial instruments, which are peculiar than the conventional instruments. However, as per the latest guidelines issued by the state banks, they have given a very overriding principle over here that all loans and receivables are to be accounted for under amortized cost method. However, usually Islamic financial instruments, especially those whose returns are on expected basis or are not solely dependent on the lending the principles, would attract some sort of debate among your external auditors as to the classification, because your classification will eventually determine your measurement moving forward. So these are the few challenges that you see. But however, considering the banking, the asset base of the banks, the usual contracts around which the products are set up, we see that most of them would be very much held on amortized cost method moving forward. Now, next I'll move on to a decision matrix used and as given in provided as in IFRS 9 is how do you apply the classification measurement. So they have given two tests. But interestingly, to note over here is that the SPPI testing takes precedence over business model testing. Now, this is sometimes a confusion or point not properly understood by the implementer of organizations. But if you see that if you follow the decision tree and if the instrument or the contract falls within the IFRS 9 scope, the first thing you test is the SPPI and interest testing. And if it fails, it goes directly to fair value through P&L. And the second is the hold to collect a business model or hold to sell business model testing. So this we need to be very mindful of above when we are formulating a debate with your stakeholders, and by stakeholders I primarily mean the external auditors. And then again, as the test progresses, the classification and measurement will follow. The other areas within this slide that deals with ECL, which we will talk about later, in our presentation, but the key point over here is that the SPPI test takes precedence over business model tests. Moving on next is the consideration of segmentation. Now we are entering the area of ECL modeling, which is the most highly debated and requires the most amount of efforts in IFRS implementation, which is basically credit risk measurement and management according to the principles laid down by IFRS9. The first choice is to have an intelligent segmentation of your portfolio, because what the principle requires is to coalesce your financial contracts or obligor into segments that depict similar traits of credit risk, because if that would be same information would be, or the segmentation would be fed into the ECL engine for computation, and some sort of PD, LGD, EAD uniformity will be maintained within those segments. So segmentation becomes a very, very important subject. Now, what usually the other jurisdictions have done is that, or what kind of solutions that are available for segmentation. One is a very mechanical method, which is quite advanced. It's called K-clustering method, in which I'm sorry, excuse me. Statistical models are being used, and what it does is that it tracks or forms the segments within your portfolio based on objective information of a number of variables, and that is being used as the most representative of similarity among those segments with respect to credit risk. However, it has a drawback, and which I'll explain a little later. And the other approach is the regulatory or historical segmentation. Now, obviously, the banks have been the markets within which the banks are exposed to have fairly been, concrete and have been established for years and years. That is, you have a corporate portfolio, SME portfolio, retail portfolio. Within retail, you have credit cards, you have auto loans, you have housing. So such regulatory-driven or historical-driven segmentation has always been around. Now, one of the problems with K-clustering method is that once you do that, then it is very likely that certain of the obligors who happen to be in corporate portfolio or commercial portfolio would end up in SME portfolio, and when the results are obtained for after ECL engine runs and decisions are to be made, especially with respect to risk appetite curtailment, it's very difficult to run that workshop having cross functional representation. So it's considered that usually the best practice is to follow the segmentation as a regulatory driven or the usual historical experience that is within the corporate, SME, retail, mortgage, and accordingly so on and so forth, because those segmentations are developed considering a number of factors, and credit risk similarities are one of the factors. So these are the challenges, and you have to strike a balance to ensure practicality as well as fulfillment of the principles of IFRS9. This is the starting point for segmentation, because this will then be used for later on for ECL engine as well. Now I'll move on to the ECL, the engine, and how the modeling, what are the challenges around modeling, and this is the key challenge in IFRS9. The other areas could be deliberated upon and could be decided upon, but model creation, validation is an ongoing process, and it's extremely data intensive, and availability of requisite technology is extremely important. But however, it's not necessarily that you need to start completely from the scratch. As I mentioned much earlier, that risk management principles have been there or have been around for a while. So there might be some models that you can leverage upon, that you use upon as subcomponents of your overall ECL engine. and it is quite expected the organization would be keeping and running certain models pre-IFRS 9 implementation. One of the key simple examples, and that could be found in any of the organization, is the ALM framework, that is your asset liability management framework. That is very much one aspect of it is very much concerned with the cash flow estimation, either contractual or behavioral, and accordingly you drive your asset liability management in your ALCO workshops or meetings. So such information or such model, such data already there could very well be used for EAD purposes. Could give you some input there, and it's not necessarily you have to drive such modeling from scratch. Accordingly, credit scoring history, that is again very much expected that organizations would have that. And to just give an example from the Pakistani perspective, regulators much long time ago, around 2007, if I'm not mistaken, 2007, 2008, came up with regulatory guidelines around obligor risk rating and facility risk rating, and not only that, they also required on monthly basis the same information to be submitted as a regulatory filing, that is under your ECIB. This is very Pakistani context oriented, and a larger audience would have another set of information that could, in principle be the same. So these information would be there, and it is during the scoping in of the model that you will make a stock take and decide whether you can leverage on that, and if it requires modification. Now, moving on next, I'll give a simple example of this leveraging on existing model from Basel's perspective. Even under the guidance given by regulators from Pakistan and elsewhere, since it is to be appreciated that Basel expected a credit loss modeling approach and the principle behind it has been around even before the financial crisis, that is from a Basel II that I'm inferring over here, especially the foundation IRB and the advanced IRB approach. So naturally, a lot of similarities could be seen over there, and it's a very good source. And regulators are also relied upon using certain components from Basel as a proxy that I will discuss in detail much later. So moving on, I'm trying to over here differentiate between IFRS 9 and the Basel, especially the foundational and advanced IRB approaches, to understand how much both frameworks feed off each other, and how much IFRS 9 could leverage upon already Basel laid down information. Now, these areas are classified into some areas, and the first one is the granularity. Now, Basel usually deals with obligor level information and obligor level scoring and assessment, or a pool level scoring and assessment. However, strictly speaking, IFRS 9, if I have to read it and apply the letter of the IFRS 9, its starting point is contract level. That is, in other words, from banking terms, I can say facility level could be used. This becomes a very big challenge when you try to apply the existing Basel models for IFRS 9. We try to tweak it in order to leverage on that. But however, even if absent the Basel requirements, so the contractual or facility level analysis is a cumbersome task in its own right. Each customer could have several facilities and several contracts, and to perform the ECL computation on that contract level becomes too much of a difficult task. However, even in the IFRS 9, the opening, the paragraphs of the standards conveys this broad principle that every organization needs to strike a balance, and the implementation of IFRS 9 should not cause undue cost or impracticality to the organization, and you need to resort to some higher level of information in order to fulfill the principles of IFRS9. And moving forward, as the capability is developed, you can have a much more precise and accurate system for provisioning purposes. For frequency, it's the Basel is quarterly, whereas IFRS 9, since as a matter of reporting, is at the very least a quarterly basis, where and the annual accounts or annual reporting are full-blown disclosure purposes. But however, you will understand for IFRS 9 to ECL to be more representative, it's better to utilize monthly data points, so you have more data points in order to reduce your estimation errors. Ownership for the Basel, now this is debatable. I've seen organizations that could be finance, that could be risk. However, internationally speaking, most of the countries that have been forefront in the past implementation, it has been the domain of risk management. However, in Pakistan as well as in GCC, you will find varied practices over here. IFRS 9 again is a composite ownership. One could take the lead, but the other departments provide critical data without which the IFRS 9 cannot move forward. And usually it's finance, risk, and data and technology, that is your IT. The challenges for the Basel and IFRS 9 are different. For Basel, it's central bank. For IFRS 9, it's central bank as well as external auditors. However, excuse me. Considering the Pakistani context, even the Basel-based disclosures are now required to be externally audited by external auditors. So you can say that the challengers are also external auditors for central bank, but that might not be the case in every jurisdiction. Now I'm moving on to more technical areas of where Basel and IFRS 9 differentiate. And this is extremely important for my later slides in order to understand the wider goal of IFRS 9 and how could it be leveraged upon for wider value grab. PD over here represents probability of default, a basic criteria for the ECL engine. The measurement standard for Basel is the average default within the next 12 months. However, for IFRS 9, the PD is being based on the staging, the mechanism, and accordingly it is applied. The methodology of driving the PD are drastically different for Basel. It's through the cycle process, and for IFRS 9, it's a point-in-time estimate. Now, I might not be going in depth in detail because I think I had this discussion with Ovais earlier as well. Moving forward, we will be having detailed webinars only on certain aspects, and that certain aspect is ECL, where PIT or TTC, how it is determined, what are the challenges, how it could be used. We'll be discussing detail because naturally 1 hour is not enough to discuss the modeling aspects, and we'll also touch upon validation. But however, the purpose of this webinar is to give a high level challenging aspects from project management perspective, and to create a symbiotic relation between the preparers of IFRS 9 as well as the challenges. So coming back to LGD area, the intent for the Basel is to reflect a downturn case because after all, the Basel is very keen on having sufficient amount of capital in case the bank finds itself in a stressed position. Accordingly, the discount rate used for the computation of to drive the LGD rate is the WACC, which is basically the cost that you have to bear in order to fund your operations. That could be equity or could be a debt-like instruments. Observation period, Basel is quite prescriptive about it and has given minimum 5 to 7 years, and for 5 years is basically for the retail portfolio and 7 years is for corporate and commercial portfolio, and the 5 and 7 years are basically a representation of economic cycle, usually according to the statistical study done by Basel Group. They believe that within 5 to 7 years any particular jurisdiction goes through through a cycle. And that is, again, reflected in your TTC methodology, that is through the cycle approach. When it comes to IFRS9 LGD, you have to use the, you shouldn't restrict yourself only to reflect the worst case scenario, but you have to use the average of economic scenarios, which is weighted according to probability of what you, in your judgment, are likely to occur. And it's a mixed approach towards the future scenario. Second would be the discount rate used as the effective interest rate method, which is used instead of fact, because again, IFRS 9 primarily deals with contract to contract basis, and this is how it works. From EAD again, for observation period, IFRS 9 is silent. It leaves to the judgment of the organization and the satisfaction of the challenger group, that is your board or external audit or regulator, to decide upon what kind of what's time horizon around which you will be computing your ECL computations. But however, I believe the Pakistani regulator has come up with a time horizon of, if I'm not mistaken, five years, and until 2020, and subsequent to that, every 1 year as progresses will be added on, and it will build up a longer history over the next couple of years. So I'm not too sure about that. Please, any of my participants can correct me on that, whether it's 5 years or even more. Again, the rest is the EAD approach. Again, the intent of Basel is to have a downturn reflection in your ECL computation, an observation period for 7 years, 5 retail, housing, or 7 years for corporate and commercial. The same approach for LGD as applied in IFRS 9 is applied for EAD approach, average economic scenarios, and the observation is silent. Your regulator would be in the best position to dictate that. The underlying economic assumption in Basel is to reflect the worst case scenario, and whether you have sufficient amount of capital to withstand such such stress regimes. Whereas in IFRS 9, it's more of an amalgamated approach towards economic scenarios, and you have to apply judgment as well as drive probabilities and weigh accordingly to apply those and accordingly work out your ECL computations. Moving forward, why I have given that detailed description is not necessarily to try to differentiate Basel and IFRS 9 from an academic perspective, because one of the best approaches or one of the best practices bank can take is that they could take IFRS 9 as an opportunity. Why I'm saying that is that IFRS 9 requires a lot of efforts in data computation, collection, capturing, enhancement of your technological capabilities, enhancement of your human resources capabilities. And if that is further extended, the bank, the financial institution could be in a very good position to even implement foundational IRB approaches or advanced IRB approaches. This is the reverse case for Pakistani GCC banks, because usually they are still under standard approaches, most of them at least. However, if you look at more westward in Western countries, you will see that they were proactive in applying Basel, and now they are applying IFRS 9. So they are taking a lot of they are leveraging their IFRS 9 on Basel information, but it requires a lot of significant tweaking. However, in Pakistan or GCC, it would be the reverse case. First, you might be applying IFRS 9, and later on, you could be using that same platform, tweaking it significantly to apply Basel. But this is how you should also see very positively of IFRS 9, because it has put you on a track to implement wider, to achieve a wider strategic goals accordingly. Moving forward, this is again the reiteration of what I have just explained, that in a perfect world, it could be seen as killing two birds with a single stone. However, it's easier said than done, but it's still, but at the very least, you will be on track of that. So one could be mindful and would be able to showcase such a journey to its board and senior leadership to obtain required budget in order to achieve much wider goals, considering IFRS 9 as a stepping stone for wider value grab. However, transition from IFRS 9 to advanced Basel would not come without its challenges, and there are a lot of methodological challenges as well as data challenges, and that needs to be taken care of. But you should be mindful that IFRS 9 could be used as a stepping stone. Moving on next, this is I've tried to give a very high level maturity of the model, ECL model that we have seen across jurisdictions and financial and organizations, and that could be classified into three categories: the basic, intermediate, and advanced. The basic uses a very simple approach to ECL by using management judgment to determine provisions. I have even seen senior leadership talk about that. Whatever you add as a spread to your loan could also be a good proxy to determine whether what is the PD of that particular financial contract, which is not entirely true with the spirit of the PD, but it's to be understood that a lot of basic approaches have been established. The challenge is how you will evaluate what the management judgment is, unless and until you use some concrete, academically proved and have an implementation experience-based model, so as to justify your ECL computations. And secondly, is it even acceptable from the standards or regulatory perspective? Might not be the case for basic approach, and you would require to beef up your model, ECL model, in order to comply with your standards and regulators' expectations. The middle one is the intermediate, and this is where most of the banks usually rest, and this is something they achieve fairly quickly, but they need to build upon that to obtain advanced risk approach, because this is again just a stopgap arrangement. The model for PD is used on statistical averages. Transition matrix is one of the quickest examples of vintage curve analysis are used to to simplify the probability of default. Whereas the LGD and EAD is concerned, if you use flat assumptions straight from Basel, or classify your products in segments for EAD purposes. This is a very simplistic stopgap approach and might not be ideal moving forward, but could be used for the time being only. Economic forecast included as management overlay. Again, the economic forecast of a highly judgment-driven and sound statistical analysis to correlate your default rates with select macroeconomic variables. It's not done. These also pose the challenge because it's not there isn't sufficient details with regards to your ECL computation, and might not fully address the acceptability of the standards or regulatory expectation. But however, since considering the gigantic task, it is a good starting point, and organizations are always encouraged to build upon that. The final is the advanced on the ladder, which is robust models are incorporated. You have a large amount of data points that you have extracted from your databases of your core bankings, and around which you drive your own PD, LGD, and EAD estimates, and that could be the ideal state moving forward. But however, the more complex the computation and the methodology is applied, the natural challenge becomes that you have to explain the same to senior leadership and the challenger group, and to drive decision-making analysis from such computation, because after all, it's not purely academic analysis. Eventually, ECL would be driving your decision making as far as risk appetite, curtailment, or expansion is concerned, or you need to discontinue any product or any line of business. But another challenge is you need to have a significant budget in order to achieve that advanced stage. Moving on next, I'll touch upon a bit of macro overlays, and I think in the interest of time, we are running a little slow over here, so I'll just quickly, complete
I think
this.
we can take further 10 minutes if guys are okay with it. You have a few
Yeah,
slides that I think we should be able to extend it. Everyone is okay.
yeah, sure. And in any case, we can continue with this webinar in a series form later on anyway, but I'll try to be as much brief as
Sure,
possible.
sure.
As far as micro overlays is concerned,
Yes, please.
it is basically to ensure forward-looking principles applied and for the derivation for the PDs, and PDs are adjusted, inflated or otherwise, as the case may be, based on varied economic outlooks. The key challenge over here is what economic factors or economic indicators best represents your portfolio. That is a key challenge. Usually, the macroeconomic indicators we hear are like EGGP, GDP, inflation, unemployment rates, agriculture output, especially for Pakistani context. Climate change is another important aspect that is best practices are adopting quickly, where rainfall and carbon emissions are correlated with your agriculture output, especially if you're too heavy in SME, agri, or microfinance portfolios. Exchange rate again, and natural resource prices. This is natural resource prices is primarily driven from GCC jurisdiction, where default rates have a high correlation with crude oil or natural gas prices being those countries' GDP's biggest share is the export of such areas. So not only you have to select those factors that are most representative of the underlying, which are more highly correlated with your underlying portfolio, but your selection of macroeconomic indicator would vary would vary within the segments themselves. So as in, agriculture would far more be correlated with agricultural output or GDP. Might not be the case for corporate. They would be more into exchange rate. GDP is a natural selection everywhere, and natural resources. So selection of multiple scenarios. So therefore, you have to be have a robust method and analysis behind what variables have you selected. Now, the selection of multiple scenarios, as far as macroeconomic overlays is concerned, SPP has laid down, minimum of 3. That is your worst to moderate to best scenario. But in illustration, it goes as I have seen like 7 scenarios. But however, the principle is to have a weighted probabilistic approach towards multiple scenarios and try to incorporate that in inflating or otherwise your PDs to drive a forward-looking approach, because PDs that are derived before macroeconomic overlays are still derived from historical evidence and might not be suitable for forward approaches straightforward. Moving on next, this is extremely important, and especially when you are making a journey from maturity, from basic to intermediate to advanced. You would never have complete set of information with you, and there comes a point that you have to rely on certain proxies. IFRS9 is a little, brutal in that sense that requires analysis on contractual basis. So if you see this pictorial representation, we see on the left side, it starts from contract level. You can apply the analysis on contract level. That would be the most preferred but highly complex requirement of IFRS. Then you can go at the obligor level where facilities are compiled together. And analysis could be made from there, or you can again, if you cannot have confidence in that level, you can go on segment level. Now, as you move across it is not advisable from standards perspective. It has its ease of use, but it's not advisable. Or you can have some regulatory proxies being given to be used, and the clear-cut example is the LGD and EAD approaches that has been laid down in SBP for the time being. However, State Bank has also given the Pakistani regulator also given the timeline until which the bank has to develop their own LGD and EAD models and computation as well. But from the implementation perspective, the challenge is to have a plan in place to move from least preferred method for the time being to the most preferred method. So that is also a challenge over here. Now, again, I'll just do a quick recap, Wes, because I think we need to open this for questioning as well. And again, the recap in itself is in 3 slides from classification, measurement, ECL modeling, and governance perspective. So straight to the classification area. These slides will be made available for our audience, so I will not discuss everything yet again, but we need to understand that the implementation challenges vary across the business model itself, the assessment of contractual cash flows, the capability developed needed to be developed for fair value measurement, having the challenges around transitional aspects on the day one implementation aspects, and the disclosure requirements of that these is with respect to classification only. So it's self-explanatory and just instates my earlier discussions. This is with respect to the next slide is from ECL modeling, and you will see that portfolio segmentation that we have discussed is a challenge. The criteria use the definition of default, which is used for the transfer of portfolio, migration of portfolio from one stage to another and back. That is a challenge to decide upon, and not only to create a long wish list of default criteria, but you need to understand that that default criteria would be used when you ascertain your PD information. So that is very critical. You also need to ascertain contractual and behavior analysis, especially for EAD purposes, and that is also a challenge over here. Expected loss model, the ECL engines, and the robustness and efficacy of that is also very important. For forward-looking data, you need to have, especially senior leadership and a board had to be very critical and challenging. But what kind of economic overlays is the management proposing, and what's the logic behind it? Moving on, and as this is with regards to governance, you need to have a proper project management approach. You need to have policies and procedures especially because unless and until it's very common in organizations that people come and go. You always are hiring or people are leaving to other employers. So you need to have a very detailed procedures aligned so people could be brought up to speed as quickly as possible. And a good practice of having a detailed procedures is that you always have a look at whether the system could be even more made efficient or not. These are quite self-explanatory, so there is no need to explain every aspect. In the interest of time, we need to open the floor for question and answers. Recommended reading, this is a suggestion from my end. I have learned a lot and still learning it. Two key books is The Credit Risk Analytics by Bart Besson and his team. And the first book, in fact, the website also provides CSV-based or Excel-based data available, and the book comes with the R programming companion, which is open source, free of cost. A good source to understand what really goes on in ECL engine, and because you shouldn't entirely base yourself or rely on your consultants. You need to develop the capability moving forward. Another very interesting book is the IFRS9 and CECL validation by Tiziano Villani, this book is primarily based from the validation of the models perspective. Another good choice of books, highly recommended. Kindly, please have a go at it. Thank you very much, Wes. I think we should open up for discussion.
Yes, Imran, thank you so much. I think it was a very detailed and very well covered presentation. Thank you so much for your time and putting this up together. I must appreciate the fact that you took your time, because having all the experience together and then combining it all in a 1-hour session is definitely a challenge. So we have our floor open now, but before we take any question from the participant, let me ask one question from my end, that you talk about that ECL actually makes a majority of the IFRS 9 implementation. So what do you say? What do you propose to enhance the capability of the people, of the system, of the organization? You had twice mentioned, and we all know that the dependency on the consultants. I have had been a consultant myself, so I can relate. What are the concerns, and I think that concerns of the industry also. So they will come, they will build the model, and then they'll do. And who will operate that particular model? Will these organizations keep hiring the consultants and paying the fee, and do they have this option of developing their own team? So what can they do in this particular scenario?
Excellent question, Avis. And I think and it's the nature of the beast itself, because IFRS 9 is so comprehensive. You had to resort to consultants in the beginning, and it's absolutely fine to do that. But however, IFRS 9 is not a one-year activity. I mean, IFRS 9, once implemented, would stay forever, unless and until you have some other standard, superseding that. So obviously, you need to invest into people. You cannot move away from that. Either you need to hire a proper resource, or you need to invest in your current team. That is basically extremely important, because the working group, finance, risk, and IT, are the people that highly interact with the consultants, and they learn a lot. But if they are, their capabilities are enhanced, so that becomes an intangible value for the organizations as well. And that is what the state bank's expectations is. But it's an ongoing process. It's not an overnight thing. You have to be patient, and you have to put money into this, into capability enhancement. Yeah. Thank you. Anything else?
And my question is, there's this dearth of resources in our industry. So I keep getting requests from people that they need a resource for IFRS 9, and I keep posting it on my LinkedIn and my FRM group and everything. But I hardly get to receive relevant CVs. People who are working in the field, I think they are pretty happy with what they are doing. But what's the problem? Don't we have enough people in the market? What are we doing about it?
I think it's you have touched a very sensitive topic over here, because what IFRS 9 does is that it brings risk management into the fore as well. And whatever the principles on which IFRS 9 is based is actually coming from, since you're from FRM, these are very old risk management principles. There's nothing new about it. But however, it wasn't a priority, because many of the jurisdictions, the banks and the financial institutions are going through a challenging time. And usually they start to move when the regulations are there. So as soon as the regulations are there, then it becomes their top agenda. And now you're looking, finding people for that. But I believe in a year or so, within Pakistani market, you will find a lot of good resources that can speak the language of risk management in IFRS 9. It's an ongoing process, but you will find. But initially, everything, every implementation is challenging. Yeah, thank you.
Yes, I do. Back in 2000 was a time that we were developing and all sort of things, and this seems to be a recall, or the initiation of that phase. It was banks were not really serious about it. Even the banks that developed 3D models, they just shelved it because it was not regulated. But since its requirement, everyone is taking it very seriously. Yes, it happens in everywhere in the world. So I think thank you so much for your time. I'll be discussing about the IFRS 9 session, and
okay, thanks. I'm sorry, I'm just interrupting here, because I have realized there are a couple of questions. I just saw that. Are there? I can do away with a couple of questions very quickly if you can just extend it for a couple of 3-4 minutes only. Okay, so one of the questions is, will the expected loss be computed on government securities portfolio? Now, State Bank of Pakistan has come out explicitly mentioning, and they have followed the spirit of the prudential regulations, that no ECL, that government securities that are guaranteed by government are insulated from ECL implications. So there you go. No need for ECL computations. However, another debate is whether the government issued securities that are denominated in foreign currencies, do they also do that? Because foreign currency is not something that you can print in a central bank. You can print PKR denominated, and for foreign currencies, you again have to go back to IMF or any other multilaterals for refinancing. So your term might be extended, and that might cause some economic loss. So whether that is incorporated or not, that is, I think, later to be seen. Too premature for that. Are we taking charge of EL in IFRS and then following a standardized simple approach in Basel? We will be taking similar charge for credit risk. However, after taking EL, less capital charge should be required. What is your view? I'm sorry, I'm not completely, able to decipher the question. Perhaps in my next webinar, I'll keep a note of it. I might discuss that aspect over here. But I believe your email addresses, my email address would be shared by Wes. So you can also, anyone is, most welcome to reach me over email address as well. Okay. Okay, fine. Will expect loss. I think,
let me share your link. Let me share your LinkedIn profile also. So if anyone wants to get in touch with you, they can. Are there any questions? I think I cannot see those questions. So if you have any, you can just.
No, I think we are done. There were only mainly two questions, but the rest, if are there, I can take it on webinar. And I urge OS. I mean, if he can, I know he's a very busy person. I think we need to come up with more webinars, especially around ECL. I mean, in the interest of time, I couldn't explain the nuances and subtleties, which become very, a bit of a pickle later on. So we can do some later deep dive sessions around some specific core areas. So, we can see into that.
Definitely. And I think it's need of the hour. There's a lot of uncertainties and a lot of confusion regarding this IFRS9 implementation. And we should definitely have session. I'll discuss it and then we can decide and follow it further. So thank you, Imran. Thank you so much for your time. Thank you, everyone.